Hey guys, as we know, the equity and income distribution is another very important budgetary or government goal. So this video will look at how budgetary policy measures can be used to promote equity in the distribution of income in Australia. We're going to look at two main tools the budget uses. This idea of taxation, and secondly, this idea of welfare. Okay, so to recap the definition or the goal of equity and income distribution, it means that everyone should have access to basic goods and services and should enjoy a reasonable living standard as seen as acceptable by society. There should be no absolute poverty, and the gap in income and living standards between the rich and the poor should not be too wide. So this idea that the income distribution shouldn't be equitable, but not totally equitable, as a may impede on the achievement of other economic goals. Okay, so what the budget can do is the budget can help redistribute final income. So redistribute final income more equitably, more equally. And so, although the government realizes that due to the market forces of supply and demand in our labour force, and the encouragement of enterprise bargaining in the workforce, the market for factor incomes would be greatly inequitable due to various skills, qualification differences, and commitments between different people. So, what the government tries to do is to redistribute this final income more equitably rather than change factor incomes or earned incomes. So final incomes are essentially, or can be written as an equation of our private income. So private income we talked about as being both earned and unearned. So either income from direct sources such as labour when you work, or from interest, or from rent, taking away both direct plus indirect taxes. So direct being income taxation, indirect being taxation such as goods and services. But also we have to add the receipt of direct and indirect benefits given by the government. So direct benefits being welfare payments, and indirect benefits being free or cheap subsidized government services. Okay, so we're going to look at how this level of final income can be greatly more equitably distributed between people in the economy. So we're going to look at, first of all, taxation. Okay, so the most obvious use of taxation is this idea of a progressive tax, and we've gone into depth about what this progressive tax actually is in our lecture on this progressive taxation. Progressive tax usually involves PAYG, or pay-as-you-go taxation on income. So let's say initially the final income of someone with a very high private income, we will see that they would therefore be taxed more by the government due to this progressive taxation. So as your income increases, you have a larger proportion of your tax being paid as, or proportion of your income being paid as tax. So this direct taxation here, I'm just going to put a negative sign, would decrease. And again, as we see, as this increases, then our private or our final incomes will decrease. And because if people have very high private incomes, there will be less direct benefit given by the government and transfer payments to them. And similarly, people will start to go to private hospitals, private education, and therefore again this idea of indirect benefits would go down as well. So their final income for those with high levels of taxation would be lower. I'm going to put in green what happens to those with lower incomes. So people with lower incomes, they have a lower private income. So automatically this means that they have less direct taxation. So direct taxation would decrease, which is a good thing. And again, however, indirect taxation, you must note, would increase as well. So that is a bad thing. Just going to put A, because of this regressive nature of our taxes, in order for the government to increase their tax base. So this will be a negative, and we'll just put that as a bad thing. However, for those on higher incomes, this is a good thing, because their level of indirect taxation proportionate to their income has decreased. I'm just going to put a plus. Plus equals good, minus equals bad. Okay. And again, if we come back to this idea that someone has a low final income, or a low private income I should say, then their direct benefits by the government would increase, because they've been mean tested, they've been asset tested, and therefore they have more claim on transfer payments by the government. And again, if they use government subsidies on education and health, we can see that indirect benefits would also increase as well. And so as a result, their final incomes would be higher, because as we can see, we're adding more due to direct and indirect benefits, and we're taking away less due to direct and indirect changes in taxation rates. Okay, so that's how progressive income taxation and many different government subsidizations of their goods and services produce. We can see that the final income for those on lower incomes, or lower private incomes, would be higher than if it were without government intervention. Secondly, we're going to look at this idea of welfare. And we've touched on this already in this distribution of final incomes through this direct and indirect benefits. So we're just going to expand on this a little bit more. Okay, so welfare is often means and assets tested. And so means, this idea relates to income, and asset relates to this idea of wealth. So income is a flow variable, and this means it is never a constant, whereas wealth is a constant at a particular point in time. So this is a stock, or what is known as a stock variable. So you can stock them up. You can say, okay, at this point in time I am worth $1,000, whereas income, you can say I earn $50 an hour. And that's the difference between income and wealth. Income is a flow, so it continually changes, whereas wealth can be measured at a specific point in time. So what welfare does, or what the government does, is they means and assets test people who claim welfare. So not everyone can claim government welfare, because they have to fulfill requirements of means and assets tests. And so this means that the government will help decide who is eligible for these welfare payments here relative to their income and their wealth. So if someone earns no income, so let's say just call this $0, but they have, say, $1 billion worth of assets, they're not going to get any welfare payments, because although they fulfill this means test, they don't fulfill the assets test. And again, if someone has no assets and they earn, say, so no assets or $0 in assets, or we have someone who earns, say, $1,000 per hour due to their contract work, the government would not pay them welfare because they have already achieved a reasonable standard of living. And so that's how the government pays out these direct and indirect benefits to the community, and especially considering that these direct benefits have a considerable impact on the final income for those neediest, it would therefore move towards this idea of equity in income distribution. So we know that equity means that everyone has a reasonable standard of living, and it means that the gap between the poor and the large are not too big. And a statistical figure that helps support this is that nearly 43%, or we've nearly halved the Gini coefficient from factor income to final incomes. So we know the Gini coefficient is a measure of quality, and the larger the coefficient is, the more inequitable the distribution of income is. We can see that following budgetary measures to promote equity, this Gini coefficient has in fact nearly halved from that of factor incomes to that of final incomes.